Today, I will be lecturing. We are towards the end of the course. We're dealing with some of the most advanced and complex issues with dealing with quantitative investing and which have to do with our ability to generate future scenarios. And that's what I will be discussing today. I discussed that last Friday. I had a sense after class that a few things were perhaps not clear, so I'm going to give you some more information today on that so that the class that we talked about last week maybe is more clear. And then I will move to the most advanced, which is the scenario generation in more than one risk factor, okay, which is which I started last week, but there's a lot to cover there. And I think that will be the end of the course. But today, what I wanted to do is I wanted to bring it all back to investing. How is scenario generation related to investing? We have seen it very much over this course, but I thought today I want to make it explicit. I want to draw explicit relationships between scenario generation and many things we have already seen so that it's clear. And maybe by doing that, a lot of what I discussed last week is not going to be looking so theoretical, and it will be more practical, I guess. Now, before I do that, I want to check on your assignment number. I forgot the name, the number. Let me just check. Hold on a second, okay? I need to check on your assignment, the one that we're doing in steps. I'm going to put it in front of you. I want to know if anybody has managed to actually get it all finished. Okay, so I'm going to share this. I'm traveling today, okay? I'll be traveling today and next week. So I am in a different place, as you can see from my background. And also I still have all the technology that I think I need, but it's not my usual technology. Some things may be a little bit slower. Okay, so here we go. You can see that. This is the assignment. And in this assignment, what you noticed is that we're doing essentially the same thing we did in the previous one, except that this is like a second step. We are going from doing things once to doing things twice. And then I ask you if you can figure out what's next. In other words, if you can figure out the next steps in the iteration that we're doing here. Okay, so what would be the, so can you give me some idea? I would like to have an idea of how you're doing with all of this. So if you can tell me, that would be helpful. You want to use the chat, for example? To tell me how, if you know what's next, if you figure out what you have to do next. Anybody? No comments? Does that mean that everybody could do it? There's no problem. Not very good at it. Okay. Let me see where I want to ask some questions. I want to know. So for example, the previous assignment to this one, the first step, assignment number 9, everybody was fine with that. Do you have any difficulties with assignment number 9? Let me start there. Mathematics here only appears in the notation. Everything else is computational, okay? But unfortunately, we have to use mathematical notation so we can understand what computations we're doing. And this is partly the challenge that you have here, is understanding the computations that need to be done expressed in mathematical form, right? And because now math is used as a language, if you have any questions, they are very easy to answer, because I only need to translate what I'm saying to what you have to do. What you have to do is easy, but the way to express it is hard. And this is the challenge in this assignment. So shall I go back to assignment number 9? Are there any questions in assignment number 9? Were you able to do them? Let me go to assignment number 9. I'm going to put it on the screen. It is an important assignment. Everything we're doing now is I guess, more involved, more difficult. But definitely more involved, more difficult, but also more interesting. That's why I want to know if these assignments are making sense. Okay, so again, I am now going to assignment number 9. Okay, so let me ask questions about this. How is this? Was everybody managed to do this? Someone asked me how to do the partial derivative last week, and I told you. I hope, well, it seems that this was understood. Were you able to finish assignment number 9? Are there any questions on assignment number 9? Assignment number 9 and number 11 are actually the same. Okay, the calculation is the same, but this is what I want to make sure that everybody understands. So could I get someone to tell me if assignment number 9 was easy, done, understood, or if there are any questions? Again, if there are questions, they will be very easy to solve. How do I plug in the numbers? Good question. Okay, so let me tell you. How do I plug in the numbers? So which numbers do you have here? The numbers that you have are the following. I'm going to write it down. The numbers that you have are the standard deviations of each of the assets. There are 3. You have those. You have a variance covariance matrix with covariances, and you also have the correlations, and then you have mean returns. Okay, so these are calculated. These are calculated. If everybody's fine here, all of this is good. This is good. You know these numbers. You're able to calculate them. You calculate them also in the previous assignment. I have no questions, so I assume this means that everybody was able to calculate these numbers. So if you have these numbers, these are saved on an Excel spreadsheet, for example, I assume, yeah? So they are saved. These are saved on an Excel spreadsheet. So when you do that, it seems that there's nothing to do here. This is just notation, just a name. So there's nothing to do there. Okay. I'm saying that we will obtain, so this is again a notation. which means that we're going to find the numbers that we want by calculating other numbers that will converge to them. Okay. So this is like, for example, how do you calculate the square root of 2? You start with the number 1, then you correct it, 1.4, then you correct it, 1.1, then you correct 1.4, and like this. That's how you approach the square root of 2. So the numbers converge to the square root of 2. The same thing that we're doing here. So that's fine. Then we start with the selection arising from the 0 correlation assumption. So you have these numbers. Yes? Have these numbers? This came from a previous assignment. So I have no answers on the chat. So I'm assuming, yes, you have these numbers. Okay. And now I have a question in the chat that says something about number 4. This is number 4. So I guess you're asking how to do this. This is what I explained last week. I'll explain it today again if I have to. I explained last week. So is this clear? Lee is asking a question. He says, I can't understand it from the 4th one. So I don't know if you mean that you do not understand the 4th or you do not understand what's after the 4th. So I want to make sure that the 4th is understood, okay? Is this understood, yes or no? Please write on the chat if number 4 is understood, yes or no? I explained it last week, so that's why I thought it was understood, but I need to check, yes or no? Please ask again. You mean please answer again? Yeah, I'll explain again. Okay, let me ask a question. Does anybody have anything that you have done that you can share on the screen? I want to see if you have done something so I can explain it on the screen. Does anybody have anything? I'll stop my share and maybe I invite someone to share something on their screen. I want to see what you have done. Has anybody done anything? Okay, I don't get an answer. So maybe what I do is I want to do this again. Okay, I want to share this. I want to explain this again. So it seems to me that the difficulty is with the derivatives. I explained it last week. I didn't get a question, so I thought it was understood. So I'm going to try again. It's my whiteboard. Okay. So I have a portfolio. I like to call my portfolio SPY. My portfolio is the sum of some allocations times my variables, which are my indices. These are the indices. Okay. And these are allocations which are given from assignment number 8. These are the 0 correlation, risk parity portfolio. Is this clear? Are we okay with? Do you know these numbers? Everybody knows these numbers? We had $1 million. So these numbers will be something like 250,000. I'm just making it up, 250,000, 500,000. Okay, so this could be W1, this could be W2, this could be W3. Your choice of W1, 2, and 3 from the zero correlation assignment should look like this. Is this okay? Is everybody with me? Maybe some of you have done this assignment instead of using dollars. These are dollars because I told you have $1 million. Maybe you've used percentages, which is fine. In this case, this would be 25% or 0.25. This will be 25% or 0.25. It will be 50%, that will be 0.5. Okay. So Sun says yes. Sun says yes. I guess that means that yes, this is clear. Or yes, it's not clear. I don't know. When you write in the chat, you can write longer, and I also encourage people to just speak, okay? I don't want to lose you now at this stage in the course. I want you to make it to the end. You've done all of the hard work. We've learned lots of things. Now we want to use it. We want to learn how to use all of these things, okay? So, all right, so this is what we have here. That's the portfolio. So this portfolio has a standard deviation. Everybody knows how to do the standard deviation of this portfolio? The standard deviation of this portfolio, it's easy to do the square, because the square is the vector of weights times the variance covariance matrix times the vector of weights transpose. Okay? So that's the volatility of the portfolio. Everybody was able to do this? Say yes or no. Yes, you did this. No, you did not do this. Yes, so B did this. Good. Sun did this. Yes. Anybody else? So you have the volatility of this portfolio. This is done. Yes. I only have 2 answers. I would like to get more answers, especially if it's a no. So Song said yes, good. Yes. Ying, yes. Yi, yes. Okay. Okay, good. All right. So the answer is yes. So you have this. That's good. All right. So when you have this, we saw here that the derivative of the portfolio volatility to each of the weights is something that we could do explicitly. We do this explicitly. We have a formula. Okay, to do numerical derivatives is very difficult, but if we have a formula, like in this case, it's very easy. And we did the formula last week. Okay, so we did the formula last week. If I take, for example, let's do the derivative. Let's do it again. Let's do again the derivative to the first weight. So the easiest way to do that is to do this. Sigma squared was this was the sum. I will have it here. Maybe I do it in a different way today. Maybe I'll do it a different way today. So sigma squared is W1 squared sigma 1 squared plus square sigma 2 squared plus 3. And now we have the cross terms, which is 2 W1 1 W2 sigma 1 2 plus 2 W1 W3 sigma 1 3, and another term, another one that doesn't have W1. It's W2 times W3 times something else, right? So the reason I don't write it is because I don't have room, but because I'm going to take a derivative with respect to omega to weight W1, this term will disappear. So now what I get is that the derivative of sigma squared W1 is what? Well, from here, I assume you know how to do derivatives. We have that. Then this gives color. So this goes here. This is 0. That is 0. And this gives me 2W2 sigma 1, 2 plus 2W3 sigma 1, 3. That's it. That's this derivative. Okay. And this is data that you already have. You got that, you got that, you got that, that, and that. You have all of this. All 6 numbers you have. Clear? Yes or no? Yes. Knowing that this is the first iteration of your weights. It's not the ones that we're looking for, it's the iteration of our weights. Okay, the ones that we picked in the original first stage, which was when which is something that this is what we could see from the 0 correlation case. That was our first iteration. That's our first iteration. Okay. So this is clear. Let me ask again. I want to make sure this is clear. I have some yes. Li, Hu, Wu, Zheng. Clear. Okay, so if this is clear, then this is something you can calculate this. You just multiply and add. You can calculate this. Yes? I'm asking you again. Please answer it again. You can calculate this. Yes or no? Yes. Okay. How about this? Note this is not exactly the derivative that we have to do. This is 2 sigma times the derivative of sigma with respect to W1. That's what we want. But this we know. You already told me that we know this. So this derivative is this thing we can calculate divided by that. That's how you do the derivative. That's how you do step 4. Okay, so I'm going to ask someone in particular here. Li Mao, you asked me is this clear? Please answer. Yes, so it's clear. So you know how to do this, step 4. So, okay, good. So I'm going to now, so this is good. We have this. I'm going to remove this, stop this share. Now we go back to the assignment. And we'll go to the assignment. This assignment is done. That's the, and then here I say nothing. I just say once you've calculated this, we'll consider next steps. So we are done with assignment 9. It should all be clear, right? Okay, so I see some people nodding. This is good. So let me now go to the next assignment. I'm going to stop the share and I'm going to go to the new share. I'm going to change assignments, but you see, when I change assignments, I'm doing the same thing. When I change assignments, in this assignment, what do we have to do? I'm explaining how we started with one set of weights and we're going to calculate new weights. So the set of weights, these are the ones that we have from before. And we're now going to calculate the new ones. The new ones will be obtained by doing this. Can we do this expression? So this we know. This we know. We know how to calculate this. We calculated this earlier, right? So that means that we know what this is. So now we know this. And what you have to notice is that we started with some weights there that have a subscript 0. Now we have the weights with subscript 1. And then they'll have subscript 2, and then 3. And eventually they will converge to the same number. But anyway, this is what I want you to do on your own. This is the last part of the assignment. So if I go back to the assignment, as we have here, this is something that you can calculate, right? So then I ask you to calculate the next set of derivatives, which you do exactly the same as in assignment 9, exactly the same. Is this clear to everybody? The only thing that's different is the values have now changed, but you calculate it the same way as we did earlier. You see what I mean by this? Is this clear? We're doing the same thing. We're doing the same thing now. We're doing the same thing now that we did before. This is called iteration. If you have done programming on a computer, that's how many programs in computers are done. You iterate. You tell the computer to do the same thing over and over and over again. But every time you get the computer to do it, every time some numbers change. So the answer is not the same. What is changing here is that when I go from one set of values to another set of values, then when I calculate my derivative, everything changes again. Okay. And then you just do this, you just repeat. I don't know if this is clear. I don't know if you have done programs like this. I don't know how much computation, I don't know how much computational knowledge you have. Let me maybe suggest something different. I'm going to use an example that I've used before. Okay, when you have a function like this, and you want to find that intersection point, you want to find that intersection point. How do you find that intersection point? When you do it is you pick one, for example, this one, which may be close, but it's not equal to what you're looking for. and then you see that the value is not 0. Okay, you want a 0, the value is not 0. Then what you have a way of getting another value here. This value will typically be closer, but still is not what you're looking for. Then what you do is you iterate again, you find another value, and then you iterate. And in this case, you see it already goes through there. So very quickly, this converges to what you're looking for. So that's an iteration, right? This is what you have seen. I assume when you do calculations on computers, this is x1, and that'll be x2. And the idea is that the sequence that we build, x1, x2, etc., converges to the solution to that. That's what I'm doing. That's what you are doing. And every time you do that, you have to do one thing. You have to check if you have finished. You have to check if you have finished. You have to check if these values are the same. If they are all the same, then risk parity holds, and then you finished. Okay. Of course, this will never be exact. Never be exact. So you have to introduce what's called a tolerance level, which is when you're close enough, you stop. For example, if these numbers are the same to say 2 decimal digits, then you stop. You say, I found it, I'm close enough. Okay. So I am reasonably sure you have done things like this when you've done computations. Now we're doing the same thing here. Also, by doing computations, which is calculate the risk neutral portfolio or the risk parity portfolio for these 3 particular indices. Okay, so I'm going to ask again, is this clear? As you see, this is not difficult. You have to do the same thing over and over and over again. Okay, so let me ask, is this clear? Please answer yes or no in the chat. Yes, so Ying is clear. Song, clear. More people? I would like to get more answers. And if it's not clear, say no, okay? I want to make sure that everybody understands this. This is very valuable. Can I ask someone? Peng, can I ask you? Do you understand this? Peng, Lily, Peng? Who? Clear? Yes. All right, I'm gonna have to assume that it's clear. So B, clear, who, clear. Peng didn't answer. Okay. Okay. All right. So if this is clear, then you know how to finish that. You just have to do the same thing over and over and over again. Okay. And in doing it like that, then you will eventually find the weights, which every time you would do this calculation, you get the same number. When this is the same, you have arrived. You have arrived. Okay, all right. So I'm going to, I hope it was clear. I hope you learned something. Okay. All right. But again, feel free to ask me questions. Okay, I want to make sure everybody understands this. It's very important. Very important. And it's not important because the risk parity portfolio is important. No, it's important because in this exercise, in this assignment, you're bringing a lot of things together. You're bringing the concept of portfolio volatility. You're bringing the concept of what's called portfolio sensitivities, which is if I change this a little bit, how much does the volatility change? This is the sensitivity. That's the derivative that you're doing. And then you're building a portfolio. Okay, imagine that you do have $1 million to invest, and you do have to invest in the Hang Seng and in hedge funds and in the S&P. You have to do this, and you're working in a company and you have to invest $1 million doing that. How would you do it? Well, you have to do it like this. Okay, so you're solving theoretical problems, you're solving practical problems, and you have to do something which is not easy, and you cannot do it in one step. You have to do a computer program which takes you iteratively to the solution. That's why this is important. Many things that you do if you're working in investing looks like this. Okay, you do something, then you make it better, and you make it better, and you make it better. And that's what you're doing here. Okay. Okay. All right. So I hope this was clear. Please try again. Okay. I don't know if I should give you a new assignment until this is clear. I don't want to make it talk to Ivy, okay, and see what we do about this. I want to make sure this assignment is done. I will be very happy when this assignment is done. Okay. Okay. So now what I'm going to do is move to the topics that I want to discuss today. And like I said, today I want to talk about the need to do scenario generation. Something that I did yesterday. We showed some techniques yesterday, but I thought today I'm going to I want to do it again by focusing on all the times in this course that we have done scenario analysis. I have a question. Have you received the new notes for today, which are the same as last week, but enhanced? I added a few more elements. Have you received them? Yes, good. Okay, very good. So I have them here. This is what you must have received. And like I did, I included some more details to make sure that what we did last week was understood. I got the feeling that you were also not understanding this. I thought you were not understanding the assignment and not understanding the lectures. So I wanted to reaffirm and make sure that you understand. Like I said, this is important. We're doing something which is sophisticated, but not difficult. That's why I want you to understand it. It's not difficult, but it is sophisticated because it implies that you have to think in many different ways at the same time. That's the difficulty, but each of those things is easy. Okay, so I wanted to start with this consideration that we need scenario generation. Okay, what is a scenario generation? The word scenario, it's an English word. It comes from the word scene, which means view. Okay, it's what you can see. In our context, is something that happens. Okay, so something that happens. So COVID-19 is a scenario. It happened. Okay, a lockdown is a scenario. You can have COVID, but no lockdown. When you have lockdown, that's a scenario. Things that happen are scenarios. Usually in finance or in investing, you call a scenario something that could happen but hasn't happened yet. Okay, so under a future scenario that the stock market drops 20%, something. Well, that's a scenario, something that could happen. And what we want to do here is we want to be able to generate scenarios. Generation means we're going to generate. Okay, that means that the scenarios that we have here are not in the past, they are in the future. Okay, it is as if we are predicting what's going to happen, except we're not interested in predicting. We just want to know what might happen, what could happen, possible future events is what may happen. Okay, that's what we do. That's why we needed a Monte Carlo engine, which is what we developed last week. But I want to explain this in more detail so that you understand. When you want to imagine what could happen, or when you want to generate what could happen, you're going to be working with variables which are unknown. You don't know what they will be. For example, interest rates. For example, the price of oil. Okay, well, the price of food, for example, could be a scenario. You don't know what, that's an unknown variable, and they're called risk factors. Anything that affects your portfolio and you have no idea what is going to be in the future is called a risk factor. And the scenario generation applies to risk factors. Okay? Most of the time, we want scenarios which are not aligned with historical events. We want, like, imagine COVID-19. Okay, has it ever happened? Is COVID-19, the development of COVID-19, aligned with historical events? Yes or no? What do you think? Is COVID-19 aligned with historical events? Yes or no? Yes, it is. Why? Because there was a case similar to COVID-19 in the year 1918. Okay. So it has happened before. The creation or the generation of a COVID-19 is something we have already seen at least once. Maybe the bubonic plague in the 1660s also happened. Okay. So these are things which have happened, but they're infrequent. They're infrequent. And sometimes we need to generate scenarios which are infrequent. This already came up when we look at stress tests. It happened a few weeks ago, okay? And other times they are not aligned with historical events. Sometimes they just have never happened before. In finance or in investing, most of the time we deal with things that haven't happened before, but sometimes we deal with things that have happened before. And I will explain. Okay? So if I go to something that we saw a long time ago, remember, I said, assume a correlation when we're looking at the snow fund. We were assuming a correlation of 50% between snow in the city and snow in the ski resort. Remember that? And then I said, well, with a 50% correlation between these two unknowns, I have a 75% chance that I make $2 million. And I have a 12.5% chance that I make $22 million. And I have a 12.5% chance that I lose $18 million. Remember this? We showed it months ago. Remember this? Well, these are scenarios. These are scenarios. They are in the future. And I don't know what will happen. I have a probability. Sometimes we have a probability, sometimes we don't. In this case, this is what could happen. So these are scenarios. We have seen them before. We did not generate them through Monte Carlo methods or what I did last week, but they were there. They came from an assumption. It was a correlation assumption. Okay. At the end of today, we will come back and see if we can create more scenarios like this. Okay, I'll come back to this example at the end of today. But we already did this many months ago. And what we said is that with this scenarios, I can calculate the risk of my portfolio. It was here. This is the risk of my portfolio represented by the standard deviation. So the standard deviation represents the risk of the portfolio. And as you can see here, the standard deviation is the combination of three events, 1, 2, and 3. And it gives me a standard deviation of about 50%. And then we use this in the calculation of the risk. We look at the return that we're going to have, and this led to the conclusion that this is a bad deal, and we did not want to do this. The risk is too high. The risk too high. Okay, so this is one way in which we use scenarios. Okay, we have seen it before many, many months ago. You see, we've already used scenarios. We didn't generate them ourselves. I generate them for you. And when I showed this to you, we just continued, and then we made a decision that this was not a good deal for us. So that was the first time we generated scenarios in this course. We have already done it. You remember this, right? That was the first time. Now, there was another time when we generated scenarios also. And that was when, I remind you, we had taken the volatility or the return, a time series over a two-year period, and then we calculate the mean of a certain investment. And then this mean of this investment, we just kept on changing the two-year window, and we kept on updating that mean throughout history. These are also scenarios, but these are past scenarios. These are historical scenarios. This actually happened. This actually happened. And they are typically done by keeping what happened on a spreadsheet or on a database. There's no generation here. This is no generation. This is no generation. This is what's called historical scenarios. They're not generated, they're drawn from a database. But we have seen that too. And these were 2000 daily scenarios. Okay. So that's another example of scenario generation, except this time the generation is historical. So we don't say that. There was another time when scenarios were being considered. At some point, I told you about the distinction between doing things theoretically, using mathematics, probability, using analytical tools, using math, and doing statistical tools, using Excel or Python. When we do this, we typically do scenario. Here, no scenarios. This is what's called parametric analysis or analytical analysis. Okay. So these are scenarios. These are scenarios generated here. These individual scenarios, all of these are scenarios. Things that happened or things that may happen. They could be simulated or they could be drawn from history. And when you generate scenarios in this particular context, what you end up doing is you end up doing fit. So this is the analysis of it, which we do with math, or that. That's also the analysis of it. Okay, this is theoretical. But if you do things from a database, then, or from a generated collection, then there will be scenarios too. Another example of scenarios. At some point, I showed you a cloud of risk and return numbers. So I remind you, this was risk, volatility. This was return or profitability. And each of these is a scenario. These scenarios are also historical. They are not generated. Monte Carlo typically does the generation of these scenarios, and these are historical. Historical. How many of them do we have here? Maybe 2,000. Okay, but they are historical, not generated. And you know, sometimes banks, for example, they have to work with historical scenarios. Sometimes the regulators, the agencies that regulate banks, want the banks to see how their holdings will hold under things that actually happen. They don't allow the banks to create new scenarios. They have to be things that already happened. We're going to see more examples of that. So this is one way of doing that. We also saw a graph like this, again, maybe months ago, where we saw that if you look at the histogram of performance of return of a certain investment, then we have this thing, and then look at that. And this prompted our thinking of non-Gaussian scenarios. This is a non-Gaussian scenario. All of this goes back to the concept of a scenario. This is another one that came up, and it was when we were studying collateralized fund obligations, CFOs, which I remind you, this was a method to borrow money or obtain leverage. And when we did that, I showed you one thing. It's actually a paper of mine. It's a result where I told you that if the correlation between my investments in the CFO increases, then certain things will happen. So this is also a scenario consideration, okay? And these are generated. They're not historical. They're generated. They're not historical. Okay, so let me continue. Because now I have another one, and this is different. This is much more interesting. We also saw this. This is also a slide that we did in the past. Remember at some point we were studying trade financing? Remember, we had $1,000. We were going to buy stock long. We were going to short another stock. We didn't know how much money we needed. We needed $1,000. We need $500. We need $0. We saw the answer is we needed $270. That was the answer. Okay. But in doing this, I had made one assumption. The assumption is interesting. I want to bring it back to your attention now. This was my assumption. I said A will increase by 10% and B will increase by 5%. Scenario. You see? I don't know this for sure. This is what I think is going to happen. And then I can do this analysis under that situation. When I showed this example to you, I told you that what would happen if after a year, so when I speak like that, I'm generating scenarios. But do we know that this is going to happen? No, we don't. We do not know if this is going to happen. We just imagine that this may happen. Because of that, it's a scenario. Now, what's interesting about this scenario is that this scenario involves two variables, two unknowns. Variable 1 and variable 2. So for example, another scenario would be that A goes up by 12% and B goes up by 3%. That's another scenario. So this example is different from what we have seen in the past, because if I look at this scenario, what is changing here is only one number. The correlation is changing. Only the correlation. So one number is changing. It's a one-dimensional scenario. Here, it's also one number. Here is one number. Here is one number. And here's one number. And here is one number. So all of these are one numbers. Okay. Well, maybe this is two. But here we have two. This is a two-dimensional scenario. The previous ones were one-dimensional. When you go from 1 to 2 dimensions, things change. We saw that last week, and I was going to do more of that this week. That's where I decided to stop, and I will do that next week. So next week we're going to see again how we do 2-dimensional scenarios or 3-dimensional scenarios or n-dimensional scenarios. Sometimes we need to do n-dimensional scenarios. Where n could be any number, could be 100, could be 1,000, million even, okay? So this is an example where we already saw that, and it's a 2-dimensional scenario. Now, maybe more interesting than that was this one. Remember this example? In fact, this was in one of your assignments. These are scenarios. When we saw the trading style called convertible arbitrage, I showed you many different scenarios. I think it was 8, maybe more, 8. See, we already did the scenario, but up until now, the scenarios were given to us. When you are doing investing on your own, typically no one gives you the scenario. You have to come up with those scenarios on your own. And this thing that you have in front of you is an interesting scenario generation because of the following. In this case, I'm considering 3 scenarios with 2 risk factors. So which are the risk factors? Can someone write it on the chat? What are the risk factors in this case? You already saw this. You already did this in the assignment. What are the risk factors? A risk factor is a variable that could change in the future in ways we don't know. And it affects our investment. So what are the 2 risk factors in this example? Who can tell me? Please write it on the chat. I want to see how much you understand. Like I told you, this is important to understand. What are the risk factors? Systemic risk. No. But thank you for answering. Thank you very much for answering. The 2 risk factors are 2 variables that can change value in ways we don't know. Which are 2 variables that we have here that we don't know? Okay, so let me talk about this because this is important. Note that in this slide, we have an unknown. There's an unknown variable called X. Is X a scenario? Is X a risk factor? The answer is no. X is not a scenario. X is not a risk factor because it's not a variable that could happen and we don't know what it is. X is a decision variable. It's not a risk factor. I have to make a decision. I have to decide how much I hedge my portfolio. That's what X is. So that is not a scenario. If some of you thought that X is a scenario because it's a variable, the answer is no. It's not a variable like a random variable or a variable that could happen. This is your decision variable. You are the one building the portfolio. So X is up to you. You control X, but you do not control the value of the stock in the future. And you do not control the value of the bond in the future. Because of that, the two variables that we have here, the two risk factors are the value of the stock and the value of the bond. And they're already here. So our risk variables, our risk factors here are the value of the bond and the value of the stock. These are our risk factors, and we have two. And both of these affect the value of the portfolio. In this exercise that we did here, how many scenarios did we consider? How many risk factors? We know it's two. How many scenarios? I know you know the answer is written in front of you is 3, but why is it 3? Number 1, number 2, number 3. So 3 scenarios of 2 variables. You see, we've already done this. But once again, these scenarios were just given to you. I gave them to you. And I gave them to you when you did the assignment too. See, what we're doing now is more difficult because when you're investing, you don't have a professor telling you what the scenarios are going to be. No one is telling you that. You have to do that on your own. And this is what we started last week, and that's what we will finish next week, is the tools that you need to come up with these scenarios on your own, by yourself, because when you're investing, you're alone. Okay? So these are the scenarios, and this is a decision variable. Not a scenario. So not every unknown is a scenario. A scenario has to be something that could happen. It's not up to you, and it can affect the value of the portfolio. Okay. Okay, so I hope this was clear. I have another one here. This we call stress test, and it was a fundamental way of doing risk management. So here we have stress scenarios, because these are scenarios. They are scenarios which are linked to historical things that happened. September 11, Black Monday, so on and so forth. These are stress scenarios. So let me ask you a question. Please answer in the chat, because I want to know how much of this you understand. These scenarios that we have here are historical or generated? Are they historical or generated? Someone write something, please, on the chat. Are they historical or generated? So this is historical. This is September 11. This is also historical. These are not generated. They are historical. So Ying, you said historical, you're right. These are all historical. They're not generated. We could generate scenarios like this, but these are historical. Let me ask you another question. How many factors are there in these scenarios? I know I'm not telling you here, I only have some investments and this and that, but what do you think is the number of risk factors in these scenarios? Is it one or many? The number of risk factors. The number of risk factors. One or many? Many. Yes, many. Exactly. How many? How many? Thousands. Why? Because this is something that happened. So if something that happened, then I look at what every stock did. That's already thousands. I look at what every bond did. That's thousands. I look at what every commodity did, gold, oil, wheat. All of those variables changed on these days, and they're historical. So there are many variable scenarios. Okay, very multidimensional. There's one part of scenario generation which we're not doing in this course, okay? But you may, I don't know, if you are studying at some point some sophisticated mathematics, you may see this. There is a way to generate stress scenarios that have never happened. It's called extreme value theory. Okay, there is a theory that generates these scenarios. We are not seeing that in this course. Okay, we're not seeing that in this course. But this is something which is important. But it's important for risk management, and we saw that, right? So when we look at one-dimensional scenarios, we have a single risk factor which is unknown. It's a stock price, a currency price, an interest rate, commodity price, credit rating and default, or many other things. Like, for example, in the case of the snow fund, there's no precipitation. There's no precipitation was a risk factor. So it could be rain, it could be hurricanes. All of these are risk factors, single risk factors, if this is what your portfolio depends on. So you see, from this perspective is how we develop this theory that we presented last week. And I remind you, this is how we looked at the way to understand the distribution of the risk factors, in this case, one risk factor. So now I'm going into what I did last week. And I hope this is more clear now, even the explanation we did. So when you have a risk factor and you know this, when this is known, then you can generate risk factors for the future. Then you can generate risk factors for the future. Okay. And how did we, this is how we do it. So everything we saw last week, this question, this basic question, which is what we answered last week, is there so we can answer this question. If I know my probability density, how can I generate scenarios which correspond to this probability density? So this is the creation of scenarios. That was the question. And I remind you of the answer. The answer was this. I take the cumulative distribution function, and I take points which are uniformly distributed in the interval 0, 1, and I apply F inverse to these uniform generated random numbers. That's how we generate one-dimensional scenarios, 1D scenario. Okay. And these are not these scenarios are random, but they're not unconstrained. In other words, they are random, but in their randomness, they are reproducing a certain determined density. Okay, so you may be looking at a, for example, let's pick a certain market. Let's say we are interested as a risk factor in the price of gold, and I want to generate the price of gold next year. I want to have 1,000 possible values for the price of gold next year. And I want the 1,000 values for the price of gold next year to be consistent with what the price of gold typically does. I don't want to create just ridiculous scenarios a year from now. How do I do that? That's exactly how I do it. It's in front of us. Okay, I have an idea of the distribution for the price of gold, which has an associated cumulative distribution function f. I take some uniform samples in the interval 0, 1, and I calculate that. This will give us scenarios in the future which are consistent with a certain observed probability rho, for example. That's how we do it. Is that clear? This is what we did last week. We already saw this, but I wanted to explain it to you today from a more practical perspective, hoping that now this is better understood. So this is what we were doing last week. Okay? And then we went and we did something in higher dimensions. So how if we do this in higher dimensions, in 2 dimensions? And then we did a certain theory, which I will review, which this is what we did, remember? We did all of this last week. But before we do that, which this I will do next week, before we do that, I want to take this thing that we did here and bring it to the context of what we had here. This already came up. Look at this. I have 2 stocks, A and B. I say A rose by 10%, B rose by 5%. I created this scenario and I gave it to you. But imagine you need to now come up with that scenario or other scenarios. Imagine you want to do this analysis like you do your convertible arbitrage trade. You don't want only one scenario, you want, say, 100 scenarios. Let's say that you need 100 scenarios. Let's imagine you do 100 scenarios. How do you create 100 scenarios? Not one, but 100. You can look at 100 days in the past. That's one way of doing that. Then you look at historical scenarios, okay? Or maybe A and B have a certain correlation rho. So now what you have to do is, let's say that you assume now that these are Gaussian, and you're going to generate future scenarios for these variables which are Gaussian with a certain correlation rho. And that will give you 100 different values for A, 100 different values for B, but these are not unconstrained values. These are values which are consistent. They're constrained to a distribution of which you know something about, you know, the correlation. So you can constrain your generation of scenarios to something you already know, like, for example, the correlation. And this is how you invest. We already did it. We did it many, many times in this course. But every time we did it, I gave you the scenarios. You're about to finish this course, so you have to be able to generate the scenarios yourselves on your own. And that's what we are doing. Okay, that's what I explained to you last week. So when in one dimension, we know how to do that. Is here. In 2 dimensions, it's more difficult. So in the case, what we saw last week is that in the case that we are dealing with Gaussian variables, there is a way to do that. So in which context this happens? So when I have more than one risk factor involved, I could have stock prices, more than one, like in our example, 2 stocks. I could have bonds, like stocks and bonds, like in the convertible arbitrage example, which you did in your assignment. I can have currency exchange rates. I can have commodity prices, price of gold, many things, and all of them at the same time. Okay, so that's one way in which this thing can come up. But we can also have things, also scenarios where the risk factors are what's called inhomogeneous. They are different. For example, imagine this. We already considered the snow. We already considered the snow as a risk factor. Imagine that there's snow as a risk factor and a default as a risk factor. These are 2 risk factors. Does it snow? Yes or no? Will they pay? Yes or no? These risk factors are homogeneous. And they typically are not going to be modeled by a Gaussian random variable. Okay, so these are oftentimes modeled with Gaussians. These are typically, these cannot be modeled by Gaussians, never. Non-Gaussians. So last week we saw how to do this, but I will repeat that next week. And when we do that, we will, if I have time, I will show you how to do this also, okay? Also do this next week. So that's what we're doing. We're solving these 2 questions. How do we generate these scenarios? Because when you generate these scenarios, then everything you need to do has been done in this course already. The only thing that's missing in this course is how do you generate these scenarios on your own without the teacher telling you this is the probability that something will happen. Okay. And then you're ready to invest. Okay. All right. So this is what I wanted to tell you today. We already saw this last week, and I will end today with this slide, which is very, very important. I already told you the importance of it, but I want to highlight the importance of that from this practical perspective I'm bringing to the course today. When you have 2 risk factors or more, but at least 2, each of the variables has their own existence independent of the other variables called the marginals, and then the dependent structure. For example, and I'm going to go back to the examples that we did. I want you to identify the marginal and the dependent structure in the examples we have already seen today. So I'm going to go to this example here. What are the marginal distributions in this example here? I have 2 risk factors. 2 risk factors. So each of these has a marginal distribution and a dependent structure. What's the marginal distribution here? The marginal distribution, I have 2. One for the stock A, and that's what the stock A may do in the future. And then I have another marginal distribution for the stock B, what B may do in the future. Okay. That's the marginal. What's the dependent structure? The dependent structure looks at the relationship between A and B. Like, for example, if A is always bigger than B, that means that the correlation is going to be positive or something like that. Okay, so if the dependence between A and B is that they move together, the correlation will be positive. And this is something that links the behavior of A and the behavior of B. Stocks usually have positive correlation. They typically move together. So the dependent structure is difficult to understand in this case because it talks about the joint movement of A and B. In a Gaussian random variable situation, this is determined by the correlation. So the correlation rho is what gives me the dependent structure between A and B. That's in this example. How about in this example? What is the marginal distribution and what is the dependent structure? The marginal distribution, I have two risk factors. I have the stock and the bond. The marginal distribution for the stock is what the stock can do, which reflects the situation of the company. If the company does well, the stock will go up. If the company does badly, the stock will go down. Okay. If the company is bought by another company, the stock will go up a lot. Typically, when companies buy companies, the stock goes up a lot. That's the marginal distribution that affects the value of the stock, which is our first risk factor. But now we have a second risk factor. What affects that second risk factor? That's the value of the bond. And like the stock, when the company is doing well, the value of the bond goes high. And when the company does badly, the value of the bond goes down. So the risk factor that moves the stock price and the bond price are related. And actually, they are driven by one other risk factor, which is how well the companies do. So some of you may argue, and you could argue, that this is not really a two risk factor situation. So one risk factor situation, how well the company does, that affects two variables, the stock and the bond. You can argue that and you could be right. Okay. The difference is that the bond normally does not go above $100. It's a bond. But this one is a convertible bond. And as you know, you can convert one for the other. That means that you can actually destroy one of these random variables to convert it into the other random variable, the one for the stock. Okay. So if you're going to be generating random values in the future, then that's how you would do it. You see, and in this case, we saw that the bond would be going to 100 and the stock would be going to 14. But then when we went and did our analysis, here we saw that the bond is now valued at 140 because the bond could be converted into stock. It's a convertible bond. So this is statistics. This is scenario analysis, and this is finance, investing. Okay, that's how these two things go together. Okay, so I hope this gives you a good framework to understand the last class, which is next week. And what I will do in the next class, in the last class, is how we generate scenarios when we're dealing with multi-dimensional distributions. First, I will talk about the multivariate Gaussians, which is here. I already talked about this last week, but I'll repeat it again next week. And I'll talk about eigenvalues and eigenvectors again. And then I'll tell you the beauty of eigenvalues and eigenvectors, especially in the context of how they allow us to generate scenarios. And maybe I'll mention this relationship to music again. But then I will go beyond that. And I will tell you how we can do scenario analysis beyond the Gaussians. I think this is where I ended last week. Beyond the Gaussians, and we will be dealing with other issues such as copulus. Copulus is the non-Gaussian way of doing dependent structure. For example, if you want, this is very advanced and sophisticated. If you want to do a dependent structure between snow and default, which we did in the first class of the snow fund, then you will be using copulus for that. Okay, and that's how I will end my class next Friday. Okay, so I hope this was useful for context. I hope assignment number 11 is now very clear. And I have almost no time, but I have maybe 1 minute for questions. Are there any questions? Okay, so if there are no more questions, I wish you a very good weekend.